cost of capital, where we calculate the cost of equity, cost of preferred, and cost of debt, as we have seen and I explained you already. And for cost of equity, we have two different approaches we are using from the beginning in many different chapters, like cost of equity through CAPM, cost of equity through the dividend discount model. Then we will calculate we have taken already bonds chapter. So in the bonds chapter, we calculated cost of debt in detail. So we will take the YTM as the cost of debt, and for cost of preferred, we have calculated the cost of preferred in the valuation of stock chapter, in which we have seen the dividend divided by the price of the stock, that we will see here. After calculating the cost of equity, cost of preferred, and cost of debt, we will calculate the weightage of all these three different type of securities. Then we will calculate the WACC. So this is all about this chapter, and we'll see the practical company, Eastman Company Chemical, and after that we will see flotation cost, how it affects the WACC. When you are investing in a new project, what you see? You see the positive net present value. Why you see the positive net present value? Because it creates value to the shareholder. Now, how we do the net present value calculation? We discount the future cash flows at a particular cost of capital. That cost of capital is being used for discounting the future cash flows, and it is being the present value of future cash flows are calculated, and it is compared with the initial investment. Then we see either positive NPV or negative NPV. So positive NPV you accept, negative NPV you reject. So why we do such kind of positive NPV projects we accept? The answer is, if a company having excess cash, it can either pay the dividend or it can invest in future project. So if it pays dividend, the dividend again comes back to the financial market, because the shareholder, he reinvests it. If the company doesn't pay dividend and it reinvests in for future project, then also the capital appreciation happens, the growth increases, and we have seen in the previous chapter, if, through the data table, if growth increases, the value of the stock increases. So that's the way. But all these things require a cost of capital. The cost of capital is very, very important. Cost of capital, as we have seen the three different category, we will for the equity share capital, the cost of equity is very much important. Let us now see what are the two different approaches we used earlier. Either you used the CAPM approach, and CAPM approach is very clear to all of you. The cost of equity is equal to risk-free rate of return plus beta multiplied by market return minus risk-free return. Here, students, the market return minus risk-free return is the risk premium, and beta, it is the we have seen in the previous chapter how to calculate beta, isn't it? If we have the stock returns and the market return, then we can calculate the covariance of the stock and the market divided by the variance of the market. Then we'll get the beta. So, and if you are doing through the spreadsheet, we use the formula we have seen in the previous chapter in detail. Either of the two ways we have seen for calculating beta in the spreadsheet. One is either you use the inbuilt function called slope for calculating the beta, or we use the regression line to calculate the beta. Here is one example given for calculating the cost of for Stanfield Enterprises. The beta is 1.5 and the company is 100% equity financed. 3% is the risk-free rate of return and market risk premium is 7%. That means market return is 10%. 10% minus 3%, the risk premium is 7%. What is the appropriate discount rate for an expansion of this company? So we will calculate the cost of equity through the CAPM. CAPM is risk-free rate plus beta multiplied by market return minus risk-free return. So risk-free rate is 3% plus beta multiplied by the risk premium 7% given directly in the question. 13.5 will be the cost of equity for this company. Now, suppose Stansfield Enterprise evaluating the following independent projects. Each cost $100 and last for 1 year. Project A, B, and C. All these projects beta, as we have seen, 1.5. So the estimated cash flow after 1 year is 125 for A, 113.5 for B, and 105 for C. So the internal rate of return is the 125 minus 100 divided by 100 is equal to 25%. For the project B, 113.5 minus 100 divided by 100 is equal to 13.5%. For C, calculate 105 minus 100 divided by 100 is equal to 5%. And the NPV at 13.5%, because 13.5 is the cost of equity. So NPV at 13.5 we calculated as 10.13 for project A. And NPV is the zero IRR. So for 13.5 IRR, the NPV will be zero definitely, because the cost of capital and the IRR, if remains the same, NPV becomes zero. So project B is zero. Project C is 5%. We require 13.5, therefore it creates a negative NPV of 7.49. Taking these three projects, it is obvious we will consider project A, because project A is giving a positive NPV. This is the way we use the cost of equity. Now, we have seen the risk-free rate of return in the previous chapter. We have drawn the security market line, and anything above the security market line is profitable. Anything below the security market line is loss-making. Now you see, very interesting situation. Those which are having below the security market line, those will be the bad projects, and those above the security market line, they will be the good projects. Here we have three projects, and project A is having, it is above the security market line, far ahead, above the SML, so it is a good project. Project B is on the SML, so indifferent, and project C is below the SML, so it is a bad project. Now, as the CAPM model uses risk-free rate of return plus beta multiplied by risk premium, so first component is risk-free rate. How we calculate the risk-free rate? Normally, the treasury instruments are used for calculating proxy for risk-free rate of return. So we can say we can use treasury rates as the proxy for risk-free rate of return. So in the treasury, again, you have short-term treasury and long-term treasury, treasury bill, treasury note, treasury bonds. So which one we should take? The CAPM is a period model, because it is the beta is calculated for a period. The return of weekly return for 3 year, 5 year, or maybe 7 years. So it is a period model. CAPM is a period model. However, projects are long-lived, so average period, that is short-term treasury returns, are taken as risk-free rate of return. If a question comes whether short-term treasury or long-term treasury, which one is appropriate for risk-free return, you can say short-term is most appropriate for risk-free rate of return. There is a normally 1 to 2% premium between the short-term and the long-term treasury returns. Long-term 20 years we can take, which is available openly, and that is normally 1 to 2% higher than the short-term return. Short-term treasury and long-term treasury, there will be a 1 to 2% difference. So the long-term treasuries get 1 to 2% more than the short-term treasury bills. Therefore, what we do? While calculating the risk-free rate, if you have for example, you have long-term treasury instruments return, then you normally deduct 2% from the long-term treasury return to get the risk-free rate of return. Why? Risk-free return should be the short-term treasury instrument return. If you have long-term treasury instrument return available, deduct 2%, which will be equal to the short-term treasury return. Now the next question is in the CAPM, market risk premium. So market risk premium is the market return minus risk-free return. So for market return, we use the historical data, and sometimes we use the dividend discount model to get the return of the market. Market data and analyst forecasts can be used to implement the DTM approach on a market-wide basis. Normally, if it is US market, we take S&P as the proxy for market return. Now, the third component of cost of the CAPM model is beta, which we already have discussed. So, I think no doubt will be there in this beta calculation. S&P 500 is represented as the market return, as I told you just now, and beta is the sensitivity of the stock's return in comparison to the S&P 500 return, if you are taking S&P as the market return. And formula wise, as you know, covariance of the stock to the market divided by variance of the market. The problems of calculating, and if you are doing through the Excel spreadsheet, we normally use the slope for calculating the beta easily. And if you want to calculate a regression line, you can draw a regression line. Both are inbuilt in the Excel spreadsheet. And we have seen this how to calculate. Anyone, if you have any doubt, you can ping me or just WhatsApp me so that I can send you in detail the previous discussions and spreadsheets so that you can do it. I have already uploaded the spreadsheets in your Blackboard. So any doubt, you can contact me. Problems of beta. Beta is widely used for calculating, for calculating CAPM. We have the risk-free return plus beta multiplied by market risk premium. Now, beta is widely used, but beta has certain problems. What are they? Betas may vary over time. You have calculated beta for 3 years. Past 3 years return you have taken and calculated the beta. When you will take 4 years, it may be different, or 5 years or 7 years, it may be different. So beta may different or vary from different over the time. Sample size may be inadequate. For example, Mr. A is using monthly return for 3 years, Mr. B is using weekly return for 3 years, and Mr. C is using daily return for 3 years. Then the sample size will be different for 3 different analysts. And for A, because it is monthly return, only 36 returns will be there in 3 years, so it might be inadequate. But he can get the beta, but it might be inadequate. Betas are influenced by changing financial leverage and business risk. Once the business risk will be changed, the financial leverage will be changed, business risk will be changed, operating leverage will change, the beta will change. Solution. Problem 1 and 2 can be moderated by more sophisticated statistical techniques and even taking the data for a longer period. Problem 3 can be lessened by adjusting for changes in business and financial risk. That means if the operating risk or the financial risk is operating leverage or financial leverage is changing, you should take into account those leverage into a calculation so that your beta can be appropriate. Look at average beta. If for example you cannot do that, then in that situation you can look at the beta or estimate of your comparable firm or most comparable competitor, and also you can see the beta of the industry. Stability of the beta. Most analysts argue that betas are generally stable for firms remaining in the same industry. That is not to say that firms beta cannot change. As we have discussed in the previous slide, it changes if the company changes its product line, the beta will be changed. If the company changes the technology, also beta will change. If the company goes into deregulation, under the government clutch it was there, now it is out of the government clutch, it is under the deregulation, then also beta will change. Similarly, if the financial leverage or operating leverage changes, then also beta will change. Now, what about using the industry beta? It is frequently argued that one can better estimate a firm's beta by involving the whole industry. If you believe that the operations of the firm are similar to the operation of rest of the industry, you should use the industry beta. But if you are thinking that your company's operation is completely different, it is not similar to the existing industry, though it is in the industry, but its operational style is different than the industry, then you should calculate for the company beta, not the industry beta. So you should use the firm's beta instead of using the industry beta. Do not forget about adjustments for financial leverage. The determinants of beta, as we have seen in the previous three slides, that the beta changes if the business risk or the financial risk changes. So business risk is generated out of cyclicity in the revenues. Sometime revenue more, sometime revenue less. Then the business risk will be high. If the revenue will not be cyclical in nature, it is very steady. All over the year, the same revenue, similar amount of revenue will be generated, no more, no less, then it is not cyclical. It is steady revenue. And business risk is measured through the operating leverage. Operating leverage is generated out of the fixed expenses or fixed cost of the business. Now, fixed operating cost of the business. Now we will see about the financial leverage. Financial leverage is generated out of the fixed financial charges in the business. So fixed financing cost in the business, or bonds or debentures, fixed bank loans, they will create the financial leverage. Now we will see one by one the cyclicity of the revenue. Some industry, some companies, the cyclicity will not be there. The revenue will be very constant. Some industry, the revenue will be cyclical. If there is a peak season, revenue will be high. If there is a dull season, revenue will be low. Then they are cyclical in nature. If whether the economy is boom, recession, whatever, normal, if the revenue remains steady, constant, then it is non-cyclical in nature. Highly cyclical stocks have higher betas. Why? Because the revenue is not predictable, it is not constant. So, empirical evidence suggests that retailers and automotive firms fluctuate with business cycle. Isn't it? Automotive firms, normally, if the economy is good, you might be thinking for buying a luxury car. You might be thinking for buying an additional car. So, automotive, for example, the economy is going recession. You will never think for spending money on additional automotive or maybe car or any kind of luxury car, all these things. In dull season, no one will think for. So, they are very much cyclical in nature. On the other hand, transportation firms, utility firms, pharmaceutical companies are less dependent on the business cycle, isn't it? For example, whether the economy going into recession or boom, the transport business will run. People will not stop transportation because whether it is a people transportation or goods transportation, they will continue. It will not be much affected with boom or with recession. During boom, you will not commute from your home to your office 5 times a day. Not at all. Same like during recession, you cannot completely avoid your travel from your home to your office. Whether it is boom or recession, you will go in the morning to your office. In the evening, you will come back to your home. So the transportation firm will not be much affected. Similarly, utilities, electricity generation company, water provider, all these are the utility providers. They are not cyclical in nature. They are not much affected by the business cycle, isn't it? And more the cyclicity, more the operating leverage. So note that cyclicity is not the same as variability. Variability is different. For example, a movie studio have revenues that are variable depending upon whether it produces a hit film or flop film. If hit film, revenue will be more. Flop film, revenue will be less. But it is not cyclical. People will go irrespective of the economy and all, they will watch. If there is a hit movie, they will go and watch. If there is a flop movie, though economy is good, you will not go and watch the movie, right? So it is not cyclical. It is variable. Variable with what? Variable with the quality of the movie it produces. If it produces a good movie, definitely whether the economy is good or bad, people go and watch. If there is a bad movie, normally people will not go and watch. What type of economy it is doesn't make any difference. The degree of operating leverage measures how sensitivity a firm is to its fixed costs. So, operating leverage increases as fixed costs rise and variable costs fall. There, always remember the as we have also discussed in the previous slide, operating leverage arises because of high fixed cost, low variable cost. A company, if two companies are there, one is having high fixed cost, the other is having low fixed cost, then the first company is having more operating leverage, the second company is low operating leverage. Why? First company is having high fixed cost, so high operating leverage. Operating leverage magnifies the effect of cyclicality on beta. So whether it is during the increasing time and decreasing time, the operating leverage magnifies the cyclicality on the beta. You can see here. So here the total cost starts from the fixed cost. Fixed cost, whether you produce or you don't produce, you have to pay. So fixed cost there from the total cost starts. If you produce zero output, then your total cost will be the minimum fixed cost. If you will produce more, your total cost will go more than the fixed cost added with the variable cost. The more you produce, more the variable cost added to the fixed cost, and the total cost line will be above the fixed cost line. Now, if for example you are going to during the kind of now there is a green line, there is a red line. Both are fixed cost. If your fixed cost is red line, company A, company B, we have taken two examples in the previous slide, A and B. A is having high fixed cost, B is having low fixed cost. So A will be like the green line. The fixed cost is much higher than the company B. Company B's fixed cost is very lower line. Therefore, you can see the total cost of company B is much lower than company A in most of the time. And company A, it's if no production also there, the fixed cost is much higher, so the total cost also will be much higher. Therefore, the operating leverage will be very high. For company B, the operating leverage will be low because the fixed cost is under control. Now, we'll go to the, as we have seen, operating leverage refers to the sensitivity of firm's fixed cost of production. So, more the fixed cost, more the operating leverage. Low the fixed cost, low the operating leverage. Now, let us see the financial leverage. Financial leverage is the sensitivity of to a firm's fixed cost of financing. You know, like fixed cost of production, there will be fixed cost of financing. When you are financing, it can be either equity or debt. Equity is variable because the dividends are not constant, but debts are fixed interest bearing instrument. Whether you produce more, you produce less. Whether you make more profit or less profit, you have to pay the constant fixed cost of the financing for the debts. So it is the sensitivity of a firm's fixed cost of financing, and fixed cost of financing arises with the debt. So debt is a fixed interest bearing instrument. More the debt, more the financial leverage. Less the debt, less the financial leverage. No debt, no financial leverage. We have seen unlevered company and levered company. The relationship between betas of the firm's debt, equity, and asset is given by the following equation. Beta of the asset is equal to the weightage of debt, debt divided by debt plus equity or the total asset, multiplied by beta of the debt plus weight of equity. Equity divided by debt plus equity is the weight of equity multiplied by beta of equity. Financial leverage always increases the equity beta related to the asset beta. So, if financial leverage is more, equity beta will be more in comparison to the asset beta. How? Let us take the example. Consider Grand Sports Incorporation, which is currently all equity financed company, and it has a beta of 0.9. The firm has decided to lever up to a capital structure of 50-50, one part debt, one part equity, means 50-50 debt equity ratio. Since the firm will remain, previously the company is all equity, 100% equity. Now the company has decided during all equity company, its beta is 0.90. That means the 0.90 will equal to the asset beta also, because that was the all equity beta, unlevered beta. We have seen unlevered beta is equal to asset beta. Now the company is thinking for making it 50-50. Instead of 100-0, it is now interested to make it 50-50. And the asset beta will remain the same, 0.90. Calculate the equity beta. Assuming the 0 beta for its debt. Normally beta of debt is normally 0 because debt is rarely traded. So if we take the beta of debt as 0, then 0 multiplied by weight is equal to 0. So the debt will be ignored. Only the beta of asset 0.90 is equal to the weight of equity. Weight of equity is equal to equity divided by debt plus equity. It has one debt, one equity, 50-50. So 1 divided by 1 plus 1. Debt is 1, equity is 1. So equity 1 divided by debt plus equity 1 plus 1 multiplied by beta of equity is equal to 0.90. Therefore, beta of equity will be equal to 1.80. You see here what happened? And in the previous statement you read it. Financial, last sentence of this slide, number 18. Financial leverage always increases the equity beta relative to the asset beta. So once you are increasing the financial leverage, your equity beta increases in comparison to the asset beta. We have seen in this example here. Company was all equity company. It has gone for debt equity 50-50. When that means financial leverage increased. Before it was an unlevered company. Now it is a levered company. That means let us calculate the equity beta. Equity beta is equal to the asset beta. Asset beta is equal to weight of debt plus beta, the weight of debt multiplied by beta of debt plus weight of equity multiplied by beta of equity. In the previous slide we have seen weight of debt multiplied by beta of debt, weight of equity multiplied by beta of equity. Normally beta of debt is 0, therefore the left portion of the equation becomes 0. 0 multiplied by anything is equal to 0. So what remains? Remains is the equity divided by debt plus equity multiplied by equity. Here the asset beta is equal to 0.90 is equal to equity 1% divided by debt 1, equity 1, 1 by 2 multiplied by beta of equity 0.9. Therefore, the asset is beta, the equity beta is equal to 1.80. Hope it is clear. Now, let me stop here.